Okay, so we do have one question in the box already from Edgar. Edgar's asking, how do I delete a line item from the closing cost detail in Edge? So great question, Edgar. Let's show everybody how that looks. So in Edge, you have two ways that you can insert your closing costs. You can do them as ballpark figures, which means you just fill out the totals up here, or you can do them as line item details, which is what Edgar's referring to. Now, one thing to keep in mind for those of you who are brand new to the system, if you've already done closing cost details, you've already done the line itemization, you notice that it grays out these fields because these are actually being totaled out from what's inside your itemization. So if you ever need to fix something inside, you need to go back into the itemization. Now what you do is go into the closing cost details, and if you wanted to be able to delete one, all you do is just hit the little trash can next to the line item that you want to get rid of, and it will get rid of it. Now that said, there's also fee templates. Now, if you want to be able to edit the template itself rather than just what's in the file, what you can do is you can go to the settings area inside Edge, go to fee templates, and then you pull up the template that you want to edit, and you can delete that from that particular template. Now, this won't retroactively to delete it on files that you've used this template for. It'll just mean that going forward, when you select this template, it won't have that item that you deleted. And Edgar asks also, how do you change the name of the closing cost scenario? So you can't change the name of the scenario, but what you can do is you do a save as. So for instance, if I wanted to change this FHA 3.5% down to be named something else, I can either delete this one, and I'll do that in just a minute, but if I want to change the name, I'm going to do a save as, and I'm going to call it whatever I want it. So maybe this is new FHA closing costs, and then hit OK. And now you can see that up at the top here I've got a duplicate. I've got new FHA closing costs, and then I've got the old one, which is exactly the same but named differently. At that point I can delete the old one. So I just left click on that one and hit the delete button. It'll ask, are you sure? You hit yes and you're good to go. So it's all out of there. Now you may have noticed there that save as function, that's effectively your copy button. Basically, if you've got a good template in here and you really only need one or two to begin with, and you want to just keep editing those and copying them out so that you can use them for different types of programs. For instance, if you've got a conventional purchase template and you want to make an FHA template out of it, you start with your conventional here, do a save as, name it what you want to name it, so FHA new, hit OK. And then we're going to go up and we're going to edit that new one. So now I can add additional line items if I need to. I can remove line items that may not apply for my FHA. But the quickest way to get these into play is print out a fee sheet for a conventional purchase and an FHA purchase, just so you can see what fees are going to be assessed by your loan origination system. Once you've got that fee sheet in front of you, you want to mirror that as a template here in Edge. So you're just going to start adding line items, add line items, add line items. And then once you've got all the line items in, enter the costs. A lot of these are going to be static costs. They're going to be the same every single time for that program. Some of them will change on a case-by-case basis. Now, those ones to look out for, and usually what I recommend is things like the hazard insurance reserves and the tax reserves. These are going to change between, you know, if you've got one loan for one amount, another for another, they're going to be totally different amounts here. Also, property values will affect these too. So you want to make sure that when you create templates and you have things that are going to be variable, you just leave them blank. Leave zeros in there so that when you pull in the template, you can edit it on a case-by-case basis. So the same thing applies to loan origination. That one, the whole reason we don't allow a percentage right there, and I know this is a question I get quite often, the reason we don't allow a percentage is because when you're doing the fee details inside Edge, Edge doesn't yet know what the total amount financed is going to be. So all it knows is what your base loan amount is. But in the detail, you have these checkboxes that allow you to add fees to the loan amount. This effectively increases your amount financed. But until you've saved that from inside Edge, and let me go back to that option we were looking at a minute ago. So inside Edge, if I was to start checking these boxes, Edge doesn't yet know what the amount financed is until I apply it to the loan, which means that these percentages would be based off the wrong amount. So be very careful about this. On a purchase, it doesn't matter. You're never going to be rolling your costs into the loan amount. So feel free to use these percentages on purchases. But if you're doing a refi where you are going to end up adding most of those fees into the loan, be careful about using percentages because they're going to be based on your base loan amount, which is the number back here on this screen. So they'll be based on this guy rather than this guy plus all the fees that you've added. So just keep that in mind. Normally, I would recommend, don't use percentages for loan origination inside the closing cost detail. Obviously, you can fool it by creating a custom line item, call it loan origination, and then you can use a percentage. However, don't use it on refis. It's not going to be the right one if you're rolling in fees. Now, what I would recommend is anytime you want to assess a point, say for loan origination, you can actually do it right here. This part here knows what the amount financed is because we've already got the detail in place. So it knows what's going to be added to the loan, which means that if you put a point in here, it'll be at 1% of that total amount financed. So this is a valid way to assess for loan origination points if you want to do it as a percentage. Now, another kind of cool thing here is on your prepaid interest days and your points, you can always hover over these, and it'll show you exactly what that dollar amount representation is. So when it comes out on your final report, the points are going to come out as a dollar amount anyway, and your prepaid interest will come as a dollar amount too. But it's good to know what these are for when you're trying to reconcile what your cash to close is. So if you ever need to check on those, just come over here and hover over them. It'll tell you exactly what they are. All right, so hopefully that answers your question, Edgar. I see that you did respond there. Thank you very much. And anybody else, if you guys have questions, please do type them in. I'm kind of just going to go over and start covering different topics inside Edge, so hopefully that'll trigger questions for you. But if you'd like to see a specific scenario set up, please do let me know. Okay, so let's start with a brand new client. This is going to be Actually, I'm going to show you guys how to do an annual review. Now, obviously, the refi market is not huge right now, but it's very important that you continue to stay top of mind for your customers. Even when the rates aren't perfect for them to do a refi, you still want to let them know, hey, your mortgage is great right now. You don't need to refi, but I'm going to show you the other options so you know what's out there. And you'll know that every year I'm going to do this for you and show you if there's a better option for you, it's time to make a move. So this is usually going to be for an individual because you do have some details about their current mortgage. So I'm going to call him John Smith. And then he does own, so I'm going to leave it at own. Now, friendly name, this becomes really important for when you're doing annual reviews. If you have a client that has multiple properties, you want to make sure to use the friendly name to designate what property this is for in particular. So this one I'm going to call annual review for primary residence. And you could even actually insert the property address there and it would be fine. Now the goals here, we're definitely doing a refi goal. I'm going to say lower my interest rate. Just remember that the only goal in here that actually makes any action happen inside Edge is the purchase goal. So when you select this one, it's going to remove the current mortgage from the presentation altogether. It won't even ask you for it. So just keep it in mind, if you do check this one and you're trying to do a refi, you're not going to see the current mortgage, so you got to come back and uncheck this one so you do see it. Now, because this one is going to be a refi, we need to make sure and fill out the appropriate fields for it. Now, current monthly mortgage payment, this one doesn't show up anywhere on the report at all. This is specifically just a notes section for you to record what your client has told you that they're paying. So let's say they've told you they've got a $2,500 payment. Now, property value is a required field. That's why it's in red here. And the reason it's required is because this does things like generate your loan-to-value ratios. You'll have empty figures in there if you don't have a property value. So let's say that their property value is $350. Now, original appraised value is actually very important for when you're doing refinances. If that particular mortgage has mortgage insurance on it, the mortgage insurance cutoffs are based on the original appraised value, not on the current value. Unless they've had it actually reappraised already and they've had their MI restructured, they're based on the original value. So let's say that when they originally got this, it was only a $300,000 house. So they've appreciated. Well, not a $3 million house. They've appreciated substantially. Now, total payoff amount actually comes into play too. Now, you don't have to use this, but you can. We put it there to make it easier for you. If you actually know what the total payoff is going to be, you can enter that figure here, and Edge will not use the current balance of your current mortgage for your cash to close calculations. If you leave this blank, Edge will use the current balance on the current mortgage for your cash to close. Now, the whole reason we did this is because we didn't want to have you forced to edit the current balance to reflect a payoff, because then your interest figures are just slightly off going forward in Edge. So I would recommend use this payoff amount if you're just refinancing a single lien. If you're going to do a resubordination or something like that, don't use this field because you actually want Edge to be able to keep part of that that second, for instance, in your new scenarios. So I'm going to leave that field blank for now because I don't know what the payoff is going to be, and I'm going to allow Edge to just use what I put in here. So let's say they got this loan a few years back. When they took it out, it was for $260, and they got it at a 5.5 rate on a 30-year term. Now Edge generates the remaining balance for me when I go through this. If you know the balance is different from this, feel free to type over this. Now oftentimes your borrower will have made additional principal payments, and that's perfectly fine. Let's say they've paid it down a little bit and they actually got a $245 current balance that you're going to pay off. So I'm going to overwrite that. Now this will shorten my freedom point on that current mortgage. So instead of being 2 years into the mortgage having 28 left on the term, they're actually going to end up, because they've reduced their principal a little bit, we're probably going to see something closer to 26 years on their term. Now if there was interest only period here, we'd want to indicate how many months from the start date, and remember this is all relative to the start date. So if I put 120 months in here, that's 10 years relative to this date up here. So we've got 8 years of interest only if I was to do that. Balloon payments, usually you're not going to use these on a first lien. So the first lien, most times you're not going to have a 30 due in 15 as a first lien. You will have those occasionally on a second lien though. So if you do have one that has say a term of 15, or actually a term of 30 years, which is what the payment's based on, but it's actually due in 15 years, you would put 180 in this field. For this case, I'm not going to do that. And then we're going to enter our monthly escrows, and usually if you know these figures exactly, go ahead and enter them as dollar amounts. If you don't know them, you can kind of use some standards that apply to your state. And then mortgage insurance, if they did have mortgage insurance on this, we want to put it in there. And this one I'm going to assume was a conventional loan, so I'm going to leave it with a 78% cutoff. I am not going to force the MI calculation to redo itself every year based on the existing balance. That's only for FHA loans, well, government loans. So you'll see that for USDA as well. And we won't need a cutoff month here because, again, that's only if you're doing government loans. So for all conventionals, all you need is a 78% cutoff. Now, this 78% is going to be relative to that original appraised value I put in. So even though their LTV might be below 78 right now based on current property value, it's still going to assess that MI until it gets to 78% of the original value. All right, let's see. Before I continue here, let me see if there's a couple more questions. Jim's question, if you enter in a point percentage in products and have it in closing cost fee templates, does it duplicate and make them add twice? Absolutely, Jim. It does indeed. So if you're going to represent a point back in that point section that we showed you before, don't represent it within the line item details unless, if you want to actually line itemize it, just make sure that there's no dollar amount in there, no percentage in there. So you're just showing a line item for it. But your points will actually be the one that are going to be assessed. So just don't double ding for the dollar amount. Edgar's question, I've been doing a lot of follow-up calls lately. Is there an easier way to access the contacts without entering and leaving on an actual contact, which is the only way I can access the conversation log? So Edgar, yeah, you're right. The easiest way to get into those is always to actually drill into the Edge wizard for that particular one. But what might make it easier, and we'll come back to this presentation in just a second, is the View All button. The View All button actually has a sort feature up here at the top, this filter, that will look inside your friendly names. So if you've got your friendly names really decked out, like say for instance this one, I've got all my purchase reports in one spot and all my friendly names are fully descriptive. In that case, if I wanted to search for something in particular, I could search for these keywords. Like if I wanted to find everything that has purchase in it, I can filter that, and every single one of these ones that's now showing is a purchase option because I've got purchase somewhere in the name or I've got it in one of the friendly names. So you can see there's my purchase there. So that filter has actually been improved over the last few months so that you can use keywords that'll search not only the titles here but also inside these friendly names. And you can even drill it down to, let's say I just want PUR. It'll still find everything with PUR in it. So even down to one character is fine. If you want to just find somebody's last name, I put an S there and I'll find my Archer Smith. But ideally, I would probably want to drill down and find everybody named Smith. Okay, Ken. Yeah, I saw your question there. Ken was remarking that when we're doing the Calc MI on balance, it's only going to apply for USDA and FHA loans because VA loans won't have any MI. So thank you, Ken. All right, let's see. Looks like there's a couple more questions in there. Matthew's question, does the current monthly mortgage payment include taxes and insurance? So what he's asking, let's get back into our file that we were working on. When we look at this current monthly mortgage payment up here, it can be whatever you want. So if you're having the conversation with your client and you're asking them, okay, what's your total monthly payment, and you're looking for a pity payment, they may still tell you just the principal and interest payment. They might tell you principal, interest, and MI. They might not know. So this is really just a collection point for what they tell you. Now, when we get into actually calculating the payment right here, this P&I payment here is just that. It's just P&I. So MI is completely separate from this. That's why we have you enter it in a different spot. Now, you may encounter on occasion, if you are right at the cusp of an MI drop-off, meaning based on this information here, you're at 78.2% and your MI is just about to drop, you might find that your P&I payment looks wrong because it's trying to assess MI in the next screen, but then it knows it's not supposed to have it. So if you ever find that that P&I payment is off exactly by the amount of the MI, what you can do is either reduce your percentage, maybe 1% for your cutoff, so it just takes an extra month before that MI drops, and it'll ensure that your P&I payment comes out correctly. Again, that's one of those things where it's kind of a perfect storm happens, where you've got just the right data entry points to make a calculation happen in the middle of a month. That's the time when you would see this. But 99% of the time, you're not going to see that happen. This will just be your P&I payment, and it won't try to back out or add MI in there. So the MI is always going to come from your data entry right here. So I like to use percentages on these specifically for government loans, but for conventionals it really doesn't matter. It's going to be a set amount of MI for until it cuts off. So feel free to use a dollar amount when you're doing conventionals. And hopefully that takes care of it for you, Matthew. Let me know if you need any more clarification on that. Okay, looks like we got a couple of long questions in here. Okay, so Marianne's question, she's asking, how do you compare two different loan scenarios for a client? For instance, a current mortgage with 20 years left, and then a second with 6 years left. And then there's a couple of other variables that she's mentioning. Now, there's a couple of ways you can do that, and actually I'll show you that in its entirety right now. I'll show you how to both pay off both of them and how to show a resubordination of that second. So there's a couple of options that you have here. So in that case, if they have a second, I'm actually going to remove the MI because they wouldn't have MI if they took out a second. And then I'm going to check yes for there is a second lien. Now once you do that, when you hit the right arrow, it's going to ask you for the second lien information. So as you saw, my first lien is a couple years old. This second lien, I'm going to say they took it out just earlier this year. So there's a different freedom point on it. And for this one, let's say they've got a $40,000 HELOC loan. My remaining balance is going to be $40,000. I'm just assuming they're paying interest only for the life of the loan. Usually these have terms of 25 years, but the term won't really matter too much on an interest-only loan here. All it's going to say is that when they get to the end of that HELOC term, it's going to require a lump sum payoff. So whenever you're doing a HELOC, just make sure that your term and your interest-only months match. That way it'll be interest-only for the life of the loan. Now, if it is a fully amortized HELOC, which I do see those come across every now and then, you wouldn't use any interest-only months. You'd run this just like a regular amortized loan. All right, so for my interest rate, let's say I've got a 5% interest rate on that HELOC, and you can see it has now generated and even though it says P&I payment here, this is an interest-only payment of $166 relative to this $40,000 at 5%. We had to use a singular label for everything on this, so it's always going to say P&I payment, even on the presentations, even if it's interest only. So really what you're looking for is just a payment amount to determine whether it's interest only or not. All right, so we've got our first two liens in there, and I should also let you know, if this is a HELOC, you have two ways of doing it. You can do it as a fixed loan, which this is going to be the easiest way to do it, not necessarily the most accurate way. If it is a HELOC, say that's tied to prime, you can make it an ARM, and then you're going to need to fill in the caps and adjustment parameters. And basically, you'll select prime as your index, and then you'll use maybe 1% as your margin. That would be a prime plus 1. But then you've also got to schedule what you want to happen to that loan over time. Do you expect it to rise? Do you expect it to fall? There's a lot more data entry that goes into it. But if you guys want to see that in full detail, I've actually got a video on it in the help area. And if you search for HELOC in our support center, there's a couple of them. I've got one that shows you how to do a HELOC that's tied to prime, another one that shows you some different figures. Let's see what we got here. Okay, so, and actually this is kind of relative to the question that we just got. How do you enter an 80-10-10 scenario with a HELOC second and edge? How to enter an existing HELOC tied to prime? There's actually a couple of frequently asked questions in here as well that talk about that. So if you want to get a little bit more detail, check out the knowledge base, search HELOC, and see what you get in here. I think this is going to answer most of your questions, but if you have additional questions on it, I've got tons and tons of videos on these. I don't publish them all in the knowledge base because some of them are very distinct towards certain types of scenarios and certain variables. But if you find that these don't solve your problem for some reason, hit the fill out a request form. And what happens is this opens up our ticketing system so that you can, and actually it'll look different for you. Let me log out real quick. So I will hit submit a request. This is what you would see if you go to fill a request form out on our site. So there's a couple of required fields here: your email address, the subject of what you're talking about, brief description. And then you've got to choose a category. We've given you lots of categories in here. If you don't find something that works for you, just choose general, and that's perfectly acceptable. This just helps us to categorize what tickets come in the end, because we want to make sure that we're always addressing the needs that come across the most. I want to make sure I've got video assets for you, all that kind of good stuff. Now, one thing that you may not have seen before, we do ask you for an edge link here, but we don't require it. I would tell you it makes it so much easier for our support team to help you if we do have an edge link, because then we can actually look at your presentation for you. You can attach files if you need to. So say, for instance, you're having a problem with one of your PDFs or something like that. Feel free to attach it to the ticket, and we'll be able to open it up from our end and check it out. And then our newest feature, you can record a screencast. So if you hit record screencast, this is going to, and I'm going to update my Java later, but this is going to open up a screen capture recorder. And I'll show you what that looks like real quick. So I get a lot of the times coming through the support box, somebody says, you know what, I don't want to type this out. You know, this is why I want to be able to call in for support. You know, this doesn't help. Well, my kickback is, look, there is no phone support. However, we give you tons and tons of tools to be able to either help yourself, or in this case now, we're even giving you a way to talk to us. So you don't even have to write it anymore. Once you open the screen capture recorder, you can jump over to Edge, hit record down here at the bottom, and it's going to start recording your screen, and then it'll listen to your mic as well. So at this point, you're just talking. Hey, support, I'm having a problem with my current mortgage. You know, this payment is supposed to be $250, and it's showing $166. What do I do? After you record it, it's going to give you an option to upload it to your ticket, and then once you do that, you'll actually see it down at the bottom here. It'll say Screencast 1, and when you hit Submit, it's going to fire that screencast straight over to us in support. And we can also respond with a screencast. So we'll tell you, and you may have seen this already if you've sent tickets in recently. We'll tell you, hey, click on the link below my signature line that says Screencast 1, and I've got a full walkthrough on how to do this. So we'll tailor those individually for you. But keep this in mind. I know it's tough not being able to talk to somebody anytime you have a question on this, but I got to tell you, most of your questions can be answered either by the knowledge base or by doing a little bit of hunting around. And if they can't, just give us a screencast. Tell us what you need, and we'll make sure you get helped. All right, so let me cancel out of there, and we'll get back over into Edge. And before we continue on with our resubordination and dual payoff, there's one more question in here. Oh, Edgar, let's discuss that question off the books. Edgar's asking for a little additional help, and I'm not sure if we can provide it, but let's talk about it. We'll see what's going on there. All right, so let's get back into our report. So now I've got a first and second lien that have been entered in here, And my first was a fully amortized lien. My second is an interest only. I've left it at fixed because I don't want to go through the hoops of inputting caps and adjustments on a HELOC loan that's really not going to move much. You guys have seen over time, prime has not moved a whole heck of a lot. So pretty safe to assume it's going to stay about the same here. All right, so affordability section, and remember this would be an annual review for somebody. So I'm now doing an annual review for a dual lien scenario. So I may or may not have this information, their income, their mortgage debt and such. It's not terribly important to capture this for an annual review because it's really not going to come into play. It's not like you're trying to pre-qualify them for a house at this point. You're now looking to show them some mortgage options so that they can see, okay, well, this is where I'm at right now. Maybe it does make sense for me to refi. I'm going to give them a call. Now, savings balance, if you're going to show them a reinvestment strategy, it's a great tool to use when you're doing annual mortgage reviews, if you do happen to know their savings balance, put it in here. Because what's going to happen is at the end of the presentation in the analysis screen, Edge is automatically going to subtract the cash to close from that transaction from their savings balance, and it's going to give them a new adjusted savings start, which is going to continue to grow. Then you can earmark the savings that you're showing them on the new refinance loans to go straight back into their savings account to show them gaining wealth there. Of course, you can also show it going into an investment account. So it's up to you whether you want to use this savings field here, but just remember if when you get to the analysis screen, if you want to do reinvestment back into their current savings account, this is where the data entry goes for what that savings account is. Now, tax bracket, definitely want to have this in here if you know it. If you don't know it, hit find tax bracket. You can find a general range based on what you believe their income is, and it's going to be pretty close. The tax benefit that shows up on these presentations, let me kind of give you a brief synopsis of that calculation. So tax benefit is we take this 28%, which we take it as 0.28, but you're always going to enter it as a whole number here. And we multiply that, let's say for the month one tax benefit. We multiply it by the amount of property tax they're paying, the interest they paid for month one, and the MI if you've chosen to tick the box to make the MI deductible. And then we add those three figures together, and that becomes the month one tax benefit. Now, when we get to the short-term area where we're showing the 60-month benefit, we're taking the totals. So the total interest they've paid over 60 months, the total property tax they've paid over 60 months, and the total MI they paid over 60 months. Adding those all together, multiplying it by 0.28, that's how we're getting our tax benefit. Now, for purchase scenarios, you'll find that there's an additional benefit that you can use, and that's the MCC tax credit. And you can get to that right here, and that's a mortgage credit certificate. This one would be added to the tax benefit as well if you choose to use it. You're not going to use this on a refi strategy, though, so I'm going to leave this blank for now. So this second one, just skip it. For an annual review, you don't need anything in here. You're not taking an application. You're not picking the client's brain. You're literally just sending them out a piece to show them where they're at and where they could be. All right, so now it's time to do some refis. Now you can see that my current LTV is at 81.143. So there actually would be an argument to say, let's just resubordinate that second. So this is actually a perfect case study for it. So for now, I'm going to show paying off both. So I'll just call it pay off both. And this is a refi, so I'm going to tick yes. And you notice that when I did that, it automatically brought in the combined total of their current liens as my new base loan amount. Now, if I didn't enter any fees or closing costs at all, right now this would be a zero cash to close situation. It's a direct payoff. Now, I am going to be adding fees in there, but I wanted you guys to be aware of what the correlation is here. If you ever find that your cash to close just doesn't quite look like what you expected, check to see what your current amounts are. You know, your current lien, here, let's go back here. I'll show you what I mean. Check to see what your remaining balances are. Now, obviously, I've got a $40,000 second, so that's why my total is $285 here. But if my total is $285, I need a new base loan amount of $285 to get a direct payoff. As long as you get those figures in line, you'll never run into problems with your cash to close. Okay, so this is the payoff both situation. Let's say that I can get them down to 4.75 right now. And I'm going to leave this as a fixed loan just to keep it easy for us. And I'm going to go into my closing cost detail, bring in one of my scenarios here. Let's see if I've got there's a conventional scenario. And you notice that because I didn't put anything in the hazard insurance and taxes in my template, I need to fill these out right now. So I need to go back in and determine, how many months reserves do I need for this, if I do need reserves, and then I need to put these in here. So let's say for hazard insurance, I'm going to need about 300, and for my taxes, maybe about 600. Now all my other fees are already in there. The loan origination, I do have it in there already, but I probably want to edit this just to make sure that the origination fee is correct. If you have a standard origination fee that you use for everything, obviously you can just keep a dollar amount in there, but most people don't. Most people use a percentage of what the loan amounts are. So I've got all my fees in there. I've got all the APR boxes ticked as I need them to be, and I'm going to hit Apply to Loan. And once I do that, all my fields are grayed out here because these are now part of the data entry and the closing cost detail. So if I wanted to, like the question was earlier, if I wanted to use the points field instead of the loan origination in here, I would probably zero this out, apply to loan, and then I'd put my point up here. And this is going to be more accurate anyway, because now you can see that my points amount 2850. That's also a great way to find out what your loan origination would be if you want. So if you wanted to tick a point here, hover over it, now I know it's 2850. I can go back into that closing cost detail, enter my 2850 here, apply to loan, and then I'm going to go remove that point. So remember, we don't want it in both places, just one or the other. But that was a quick way to find out exactly what that percentage equates to in a dollar amount. A question from Laura. What is the contribution? All right, so when we go into the closing cost detail, there's a couple of ways to indicate a contribution. Now, in this case, the contribution is this line item right here, because this one is being paid by the lender. Now, this is just assuming that, in this case, this fee is being paid by the lender. It doesn't reduce the cash to close. It's just saying that this one's covered. Now, when you want to actually enter a contribution that's supposed to knock down the other fees, what you do is you add a fee, and then when you hit the drop-down selector, you can always type in the first letter of the fee you're looking for, and it's going to take you over to that area. So I'm going to type in C for contribution, and then I'm going to select the contribution line that's in here. This one has logic tied to it. If you were to do a custom fee and call it contribution and then put a dollar amount in here, it's just going to think it's a fee that's paid by the lender. But if you select the one that we gave you, the one called contribution, this knows that whatever dollar amount you put in here has to knock down your cash to close by that amount. So let's say that there's a $1,000 lender contribution. When we knock that in there, you can see that now the lender paid goes up, the borrower paid goes down. That's the important part. Now, if you want that contribution to apply to the APR, you would check the APR box. If you don't want it to apply to APR, leave that unchecked. All right, it looks like there's another question real quick here before we move on. In the closing cost details section, my fees are lender paid. My charge is 1.75. If the lender is paying back for the chosen interest rate, how do I show the client that they are getting that 3% paid by the lender and that over the 1.75, all the rest is going towards their other closing costs? You know, Marianne, I'd need to see that breakdown actually. I'm sorry. That's going to be a little tough for me to put together right now. I'd probably need to see your fee worksheet to see how that's done. But if you're willing to send that over to us over in support, I would definitely be able to put that together for you, and I'll build a video for you as well. All right, so back in the closing cost detail, and I kind of glossed over this. When I did the contribution, you notice I ticked it as a lender. If you wanted to make it a seller-paid contribution or a broker-paid contribution, you could select otherwise here. This is a refi transaction, so I'm not going to have a seller-paid contribution in this particular case. But if you do need to, you can change those at any time. Okay, so now that I've got my details in there, you notice that I have a negative amount for my non-APR costs. Now the reason is I've got a $1,000 contribution and my APR costs were less than $1,000, or my non-APR costs were less than $1,000. So what Edge has done is it's subtracted that $1,000 from the non-APRs because I didn't tick the APR box. Now what's important about this is it's not going to reduce your APR as a result of that contribution. Now, if you need this to zero out, and you need it to be dead on perfect, you can actually separate the contribution into two parts if you want to. But keep in mind, most times your contribution is not supposed to affect the APR. It's supposed to keep the APR up at the top. and the contribution basically knocks down the cash to close. Now there are some specific loan scenarios where the contribution is allowed to tick down the APR, but make sure to consult your guidelines on those. You don't want to be caught in a problem by quoting an APR that's lower than what it should be. So I would say, most of the time you're going to want to leave it non-APR. Now what Edge does, it applied that $1,000 to the non-APR costs, and now that we have a negative 211, it's just going to subtract that from the cash to close, which means that this APR field up here is not being affected, which means your APR isn't affected negatively. All right, so last part here, I just need to put in my my escrows again. Quick tip for those of you who like to use keyboard shortcuts. You may have noticed that I didn't move my mouse when I did this data entry here. What you can do is anytime you start on the top field, when you hit tab, it's going to go to the next available placeholder. So let me put this back to where it was so I can show you what I mean. So if I'm up here and I hit the tab key on my keyboard, it's going to go to the next one. Now when you have buttons like these guys, when you hit the tab from this one, it's going to land you on here. And you can see it's done that. My next keystroke is a spacebar. Spacebar presses the button. Then I hit tab again, and I'm over in the new field. So I haven't had to use the mouse once. This might help you. I know a lot of you are trying to save keystrokes. This is a great way to do it. Or trying to save mouse movement too. I always do this actually. But it's just an easy way to get into those fields. Now, this one is editable. So if you want to, if there's an additional monthly payment that they're making that you wanted to be included in the pity payment, you can label this however you see fit and put the dollar amount in there. We also see this on occasion for a purchase transaction where somebody is trying to show energy efficiency savings. You can overwrite this, call it energy efficiency, and put a negative amount in here, and it'll actually offset the pity payment. So just be careful with that. If you're going to put a negative offset in there, just make sure it's disclosed fully. I mean, you don't want to have a pity payment come out and bite you because it's not the real pity payment. It's a pity payment that's been reduced by efficiency savings or something else. Just make sure you've got a good disclosure about it. Or during your video, explain it in detail. That makes it a lot easier. Okay, so since I'm refining both here, you can see my LTV is at 81.43. I'm going to need mortgage insurance. And I'm going to do conventional here, so 0.9 is probably what I'll get at that rate. I might actually be able to get 0.75, but consult your mortgage insurance company to find out the rates on those. This is conventional, so I'm going to leave just the 78% cutoff. I don't need to calc the MI on the balance. I don't need a cutoff month. If I do want tax deduction on that mortgage insurance, I want to make sure and tick that box. So now I've got the pay off both scenario in there. Let's see what a resubordination looks like. So I'm going to add another product. Now the first thing I'm going to do here, and anytime you're doing a resubordination, please do it this way. Otherwise, if you start from the back and try and make your loans work the way they should, you're going to run into an endless circle. And then I'll have to go into your presentation and do just this for you. So here's how to do a resubordination. The first step, copy from. And you're going to copy the current scenarios. Now what this does is this brings in that existing first and second lien that you have back here in the assumptions. It brings both of them in as existing mortgages. Now our job is to take and make that first lien not an existing mortgage because we're going to refinance it. But we're going to leave that second lien alone. It is going to stay a current mortgage. It is going to stay no refi. So I know that my first lien has a remaining balance of $245. I'm going to copy this figure. And I'll show you why. Once you toggle the refi switch, the base loan amount becomes a payoff for both. You don't want that. We just want to pay off the first. So I'm going to put my 245 in there. Oops, one too many zeros. And now that's enough to just pay off the first. So let's say I've got my 4.75 rate there. I'd want to insert my closing costs. Go down to that conventional 30. And then apply to loan. And then when you hit the right arrow, because we use the copy function, it already copied over our factors, our hazard insurance and property tax. But look what it also copied. It copied that second lien for us. So this is automatically ticked as yes. And if you hit the right arrow, you'll see that this is the same second lien that we have back in the assumptions. And we want it to stay this way because we're resubordinating it. Now, keep in mind, If you were to come in here and just try to check the existing mortgage box and hit no for refi, you're not going to have the details necessary for Edge to be able to calculate the freedom point perfectly for you. It'll be a little bit off. You might even have some payment issues. So anytime you're resubordinating, always copy the current first. Then on the first lien, mark that yes, it's a refi. Leave the second lien entirely alone. You want it to be exactly the same as the one that's in the current. Now, there are costs for the second lien. We need to put a resubordination fee, but since we're resubordinating it and it has to be an existing mortgage, it's not going to apply any closing costs you put in there. So if you do have a resubordination fee you need to assess, do it on the first lien. And we can do that by going into the closing cost detail. And then I'm going to add a custom fee. I'm going to call this resubordination fee. That is an APR fee. And then down at the bottom here, I'm just going to put in whatever that amount is. Say it's $300 or something like that. And I'm going to apply it to the loan. So we don't ever want to put any closing costs on an existing second, or an existing mortgage for that matter at all. It won't assess it an Edge. It figures it's already closed. There's no reason it should have closing costs. All right, so the last thing I need to do is I need to probably go back and rename this guy. So we'll call this one resub second. Joey's question, what if they're going to pay off both the first and the second? What would we mark off in the monthly escrow page? Yes or no that it has a second lien? So in our first scenario, we actually did that. That was paying off both. And because we created it from scratch, we basically let the refi switch do the work for us. It automatically said, no, there's no second. So we definitely wouldn't want a second if we're paying it off. So new scenario, we're paying off both with one lien, which means it won't have a second lien. Whereas in the resub scenario, it is going to have a second lien. Okay, so now it's time to check out what we can do with this. Now, you can see that pay off both is not a good option for this client. It actually costs them $22 more than their current mortgage does. Now, in the same vein, down in the short-term area, it's really not saving them much money over the 60-year period or 60-month period of time, because they've got closing costs they have to overcome before they can break even, and they've barely broken even at 60 months. So I probably wouldn't recommend paying off both to this client. But check out what we've got over here on the resubordination. They've got a good-sized monthly savings, which we are going to show a reinvestment for, and they've got a significant amount of interest savings after they've recouped their closing costs. This is just at the 5-year point. And this is going to grow once we show a reinvestment for this money. So here's what I usually recommend when you're showing a resubordination. Now, first things first, we need to change our benchmark here, because we never want to show a savings on the current. So what I'm going to do is I'm going to select the current to be the benchmark. And you can see that when it comes out, it'll show the negative $22 savings. Nailu's comment real quick. She says, actually, this is a good option to pay off both, as the new loan amount is principal and interest payment, whereas the current second is IO. Absolutely correct. So what Nailu's talking about, obviously, we're going into a fully amortized loan, and we're pulling the interest-only part out of it. So long-term effects, if we were to push this short-term savings out to something like 300 months, they're definitely going to see a good return on the pay off both section. You can see going to fully amortized nets them a good chunk in the long term. But you've got to remember, how many people are going to stay in this loan for more than 5 years? You know, rates have recently shot up just a little bit. Do we expect them to keep going? Do we expect that we'll have another opportunity to refi? It depends on what your vision is for how long you want their mortgage plan to go for. And so Nailu makes a great point. It absolutely is a better option in the long term to go with the fully amortized loan. But what if we can show them that by reinvesting this savings is $198 back into their current second, maybe they can pay it off a little bit faster, and now they've still gotten out of the IO loan, but they've only got one loan left, and it's for a lot less principal. So let's see what that looks like. So if we go to our adjust reinvestment strategy, we can earmark this $198 cost savings to go into either one of these liens. Now, obviously, we don't want to put it in the first, because the first has a fairly good rate. It is fully amortized. We want to get rid of this second as fast as possible, or at least cause it to be a lesser payoff by the time it gets to that balloon point. So I'm going to put in my 198.21. And you can see that by doing that, I've reduced the freedom point on that loan now to 12.25 years. Let's see what it does for the overall. Now remember, in Edge, what triggers your save points are always these left and right arrows. Now we've done some work inside the reinvestment screen. I need to save it. So I just basically did a left to right there, and you can see that it recalculates all this data. And now with the resub second, over the long term, because we've gotten rid of that second over time, and in fact we could drill it down even further and say after that second's payoff, I want the rest of that money going straight back to the first and pay that one off faster. I'll show you that in just a second. But you can see that just by earmarking that second to take this 198 savings and start piping it into the principal on that one, we've got a significant savings that we can show them. So as you saw earlier, it really depends on what your prospectus is for your borrower. If we're looking at a 60-month area, it's not a huge savings on either one of them. But if we go out a little bit longer term and we want to recommend a reinvestment strategy going forward, both of them can become great options for getting out of their current situation. There's certainly a pitch you can do for either way. But again, this relies on what your client's goals are. So if your client's goals are, I want to keep this mortgage until it's paid off, okay, we probably want to go long term there, and we can recommend either the payoff both or the resub second. If their goals are, well, I plan on being in this mortgage for maybe 5 more years, and then I'm probably going to sell this house and try and find another one, then we need to look more at the short-term goals, and I would probably recommend resubordinating the second at that point. All right, so now that we've got our reinvestment strategy going, we're showing what happens if they paid off both. I might actually even go out a little farther just to make it more fair to that fully amortized loan, and I'll take it out to 10 years for my short term. So I've got all my calculations in place. I think one more thing I got to do back in that analysis screen is I'm going to make sure and choose total interest and MI paid. This is going to be one of your key metrics. I would recommend for most presentations you're going to start with this because this is really the part of the loan that they can't recover. Net worth is great for when you're showing a reinvestment strategy that's developing assets for them. For instance, you're piping money back into their savings account, or you're piping money into a new investment vehicle. You definitely want to show net worth because net worth is a combination of their total equity at that point plus any liquid assets that you developed for them. Principal paid, again, that kind of relies on what your client's goals are. How much of your mortgage do you want to have paid down? If they indicate that that's definitely an interest of theirs, go for it. Show them the principal paid. I mean, you can see in their current situation, they're actually paying more principal over time than they are in these new ones. So it kind of makes it look like the current is best. But when we really isolate this, when they finish paying off all these loans, they will have paid the same principal. So it doesn't seem as important to me. I would say interest and MI paid, we've got a $50,000 difference in the interest and MI paid between these two products. That is definitely going to overcome the $10,000 principal difference over time. So the cash flow is going to be exactly the same. It's just a matter of how much unrecoverable costs are they going to be forced to pay in these mortgages. So I'll leave it on interest and MI paid. And then contact information, of course, you definitely want to fill in your borrower's contact information if you do know you should know their property address. Oops. Now, if you want to, you can actually use this street address field when you're doing a client report, not a marketing report, but when you're doing an individual report, you can reuse this field if you want. This appears directly beneath the title of your report that says total cost analysis. So you could potentially put your annual review, and then I'm just going to get rid of these just so you guys can see what it looks like on the presentation. And I'm going to use that as my street address because this is going to show up right under my title. The last part here is I need to make sure and edit my payment notes. If you guys don't use these, you should really start. There's a lot of new laws that are going to be coming down from the CFPB pretty soon here. It's a good idea to start covering yourself with anything you can. So when we talk about what these payment notes are, they appear directly beneath the payment. I'm sure you guys have all heard the lingo. It's got to be in close proximity to the payment. This is right under it. So this is what you're going to use to help soothe compliance a little bit. let them know if taxes and insurance are included in the payment. In this case, they are. So I'm going to go ahead and pull out that variable, and they are in the payment. If there was any additional notes that you needed to mention here, for instance, you've got an arm that you expect to have 3 adjustments. You can put the adjustment scheme here if you want to. That's definitely going to help you. Just always remember that if you leave this section blank, you're missing out on a chance to cover yourself. So just keep it in the back of your head. Okay, Laura's question. Oh, yeah, that's right. I forgot to show you how to do this. She says, how do we change the extra cash to go towards the first mortgage after the second is paid off? Okay. So back in the analysis screen, we're going to go into that reinvestment strategy again. Okay, so we know we're paying off this second in 12.25 years. I'm going to find out what that relates to in months. So 12.25 times 12. That's 147 months. So that means at month 148, I will have this 166.67 plus the 198.21 at my disposal to reinvest. So I know that I'm going to start that at month 148, just keeping that in the back of my head. So I'm going to take that 166.67 plus 198.21. That's the figure that I'll have available to reinvest at month 148. So what I'm going to do is I'm going to double click on this guy. So from month 1, I'm going to start out paying on the second, and this is going to go till it pays off. Now, and I actually double clicked on the wrong one. At this point, I'm going to double click on the first. So we have no reduction payment going into the first just yet, but at month 148, we want to start one. So I'm going to change this month here to be 148, and then I'm going to go and collect that dollar amount, 364.88. And by not entering any more line items, what this is saying is that at month 148, a payment of 364.88 starts going into the first and continues until it's paid off. Now, if you needed to do a lump sum or something like that, a lump sum you'd need to cut off. So let's say I wanted a lump sum at month 120, right? I knew the borrower was getting $10,000. So I'm going to change my month here to be 120. I'm going to put $10,000 right here. And I only want that to be a one-time payment, so I need to add an additional line item for month 121 and keep it at 0. Now, once you do this, you notice that it reorders these for you. You can see we've got our lump sum payment at month 120, and month 21 it goes to 0 again, continues on at 0 until month 148, where we're showing the reinvestment of that second plus that 198 that we were already showing. So just for the sake of avoiding confusion on this one, I'm going to remove the lump sum. I just wanted to show you what it looked like. Okay, so now what I'm showing is I'm showing 198.21 going into that second until it's paid off at month 147. Then at month 148, I'm starting up a new payment of 364.88 straight back into the first. Let's see what it does. So now, since we've customized it, we've now got a freedom point of 24.58 years on that first lien as well. So if we look at their current situation, you can see that they're looking at 26 years for the payoff. That was a pretty good guess by me, by the way, for the first, and 24.83 on the second. You're actually getting them to a much shorter point here. Not only are you getting this HELOC paid off in 12.25 years, but you're also knocking down that first lien, if they were to choose to keep this for the loan term, down to 24.58 years. So you're saving them a ton of money at this point. So let's see what that equates to in our short-term area. So I'm going to trigger a save, and I'm going to go back into it, and let's see what it looks like. Because remember, our reinvestment starts at 148 on that first lien. So I'm going to go to month 200, let's say. And now there's a marked disparity. And we can actually see that our long-term interest in MI paid, it's roughly the same here between, well, at least relative to what we saw earlier. But the real crux of this is when we see the difference in the short-term area, after we start making that reinvestment payment into the first, we're paying it off pretty drastically. Now, when I do this, if I'm going to show a 200-month short-term, I'm going to show a 30-year long-term, because I want to see exactly how these perform over time. This is for the life of all 3 loans going forward. So we know that by making this strategy come into play for this borrower, At the end of everything, when it's all said and done and paid off, we saved him $70,000 in interest. I mean, that's pretty remarkable. Excuse me. So I'm going to pull this back down to 120. And this, because it's going to be an annual review, I've got all the figures I need in there. I've got all the reinvestments I need, but there's a lot of working parts on this one. So this is kind of a very detailed annual review because we're not only resubordinating, but we're restructuring. We're offering some ideas on planning for their future by paying down their mortgage. And we probably need to go through this report with them. But I would say in the interim, because most of your annual reviews, you're just kind of going to fire out there and see what you get from your client, you want to put a video on it. So we're going to go to the last screen of the presentation area. Make sure there's a quote date on it. This is another one of those compliance features. Then hit Generate Link. Now this link is ready to go as is, and if you want, you can send it out. But I would tell you that because there's so many moving parts on this particular presentation, the borrower is going to have a hard time figuring out what you're trying to show them without a little bit of guidance. So it's up to you. You can write it up if you want to, but it's not going to have as much effect. I would say the best option is always going to be to add video to it so you can explain what's going on. So in order to do that, what I usually do is I'll copy the link at this point, and I'll even probably open up an email and paste it into the email so I have it ready to go. And then I'm going to go to Add Audio Video. Now as an originator, I'm going to take a look at this and I'm going to examine which parts I think I need my client to see. And I'm going to highlight those parts. So one of them is I might actually want to show them that the blended APR that I'm offering on these two new prospects is definitely better than what they're getting on their current situation. So that might be a good talking point for me. Another one, I might want to show them that the tax benefit, it stays roughly the same on the payoff both, actually goes up a little bit, but tax benefit does go down a little bit on the resub second. That's because they're paying less interest. But I'll keep those unmarked for now. Now there's no reduction payment on the payoff both because they're paying more for that situation. But there is a reduction for this guy. Now if I highlight this, they're just going to see custom, so it may not make a whole lot of sense. Instead, I'm going to go into my reinvestment strategy, and I'm going to go straight over here. And something that's really cool about Edge is that if I was to close the report right now by hitting the X up here, when my client clicks on the link, he's going to see this. He's going to see whatever state I left this report in. So the highlights that I left, whatever I left popped out, if I close it without closing these guys, this is going to show up just like this when my client clicks the link. So this is a great way to drive their attention to a specific area in the report to begin with. And then when you're recording your video, you're going to tell them, look, I know it's starting off at this point. I want you to take a look at this first, and then go ahead and hit OK on it, and then it'll allow you to click on the closing costs, for instance, and then you can click into the fee details to see what the fees are and how they relate to each mortgage. And you can drive them through each one. You know, here, go to the payment breakdown, and you'll see exactly what we've done by customizing your principal reduction payments. But I would say reinvestment strategy, this is probably the most important part of this particular presentation. So we really want to get the point across to the borrower. So I might just leave it just like this after I'm done recording my video. So the video is going to come up and play, and they'll see this screen as well. But in order to record the video, I need to drop this screen for right now. So I'm going to bring that up after I record the video. Now keep in mind, your video recorder only captures what comes through your webcam. So that means just the audio stream of your smiling face and your voice. It does not capture your mouse movements. So if you're trying to point things out while you're recording, understand that your client is not going to see your mouse. It's only going to see the end result of your highlighting whatever you leave popped out like I showed you a moment ago. Now when it comes time to record, if you've never recorded before in Edge, you want to make sure that your setup is correct. And you can do this by right-clicking on your presentation and then hitting Settings. Now this is going to bring up a little box that's going to allow you to choose to allow and remember that Edge can use your webcam. And then you're going to want to make sure that the correct mic is associated. Now right now I'm actually talking into this USB headset, so I probably wouldn't want to use the same one I'm talking with you guys. But for most cases, you guys only have 1 or 2 mics available. I have like 6 of them in here. But make sure that the appropriate one is selected. Make sure you see your voice bouncing the meter when you're talking. And then go over to the camera. Make sure you've got the appropriate webcam selected. If you're on a laptop, you may have an integrated webcam already available for you, so you won't need to go buy one. If you see it in here, it's available, so you can choose that. My laptop is on a dock right now, so I'm going to use the outside attached webcam that I have here. Once you hit close, hit record message, and there we are. Hi, everybody. So as you can see, it's pretty easy. There's not a whole lot to setting up your video camera and the sound for it. It's really just a matter of getting prepared. Now, a couple of key things you need to do to get prepared for Edge video. One, shut the door. Make sure your office is locked up so nobody can barge in while you're recording. Two, turn off your phone ringers, both your cell phone and your landline. Turn them off. You don't want to be bothered by that. Turn off Skype. Turn off your email notifications. Just make sure nothing's popping on the screen while you're trying to record. If you've got a very brightly lit room, for instance, you've got a giant window behind you with pouring sun in, it's going to wash out your complexion a little bit. So close the blinds. It's going to make it so your video recording looks a lot better. Another thing is try not to look at the screen the entire time while you're recording. When you look at the screen like this is what your client is going to see. They're going to see the top of your head. And in my case, I don't want them seeing the top of my head. So I'm going to keep my eye focus on the camera here. Now, in order to do that, the easiest way is write up a bullet point list of everything you want to cover in your video. Keep in mind, you don't want to exceed about 2 minutes. You're going to lose their attention after about 2 minutes. So write up a good 5 or 6 talking points that you want to make sure you cover in your video. Put it on a little sticky pad, one of these guys. Put it on one of these guys, and then stick it right behind your webcam. That way you're constantly keeping eye contact with that webcam, and you don't have to worry about them seeing you looking around to try and figure out what the data is. Just keep it simple. Keep it very cursory on your talking points, but make sure there's a call to action at the end. Make sure and let them know that we can go through this reinvestment strategy in full detail when we talk. So please call me right away so we can make sure that you're making the most educated mortgage decision possible. So something quick and simple like that. But just make sure there is a call to action at the end. Make sure that you represent just the top level points during your video. You don't want it to be too confusing. But the good thing about that is once you do it this way, all you have to do is hit record. You're going to hit stop when you're done, and it's already part of your presentation. So when you go to send this link out, that short link that we showed you earlier, it's automatically going to have your video attached. Everything that you left in place, your highlights and such, will be there when your client opens it. And now you've got a presentation that's talking to them when you're not there. And in fact, you'll find that these do get shared a lot. So you want to make sure that your video is appropriately talking about what you're trying to cover with this, because they may have a friend who's in a very similar situation that says, hey, you know what, I talked to Edgar, or actually Edgar sent me this link with this presentation, and he's got a video on it that explains that I can get rid of my second mortgage by doing a refi of just the first. Isn't that crazy? You want to take a look at it? Here. And they send it over to him. And if that person doesn't know who Edgar is and he doesn't want to place the call up here to Edgar, you got to have something with this to explain it. Otherwise, you're not going to catch that lead. So always, always attach a video to it. It's going to be your most important asset for your Edge reports. All right, so let's see. I think there's one more question here, and then we'll go ahead and wrap. Actually, Benjamin's question, will we be able to import a video made outside of Edge at any point? Not currently. And the reason for this is I've actually tried. There are such strict specifications for the video that runs through Flash that for you to be able to produce an example that would work in Edge, you'd have to have a degree in video marketing. I mean, it really took me a long time before I could even do it. Failed at it miserably the first couple of times I tried it. And even then, I'm actually just pushing that video up to a server in the cloud. So I would say that at this point, there are no plans to allow for videos to be uploaded because it's just too darn difficult to get it in the right format. And we don't want to make you work at becoming video editors. We'd really rather keep it a streamlined process for you. By hitting record message here, it automatically formats it in the perfect format for Flash, and it ensures that there's not going to be any issues in your video going forward. So to answer your question there, Benjamin, we don't have any short-term plans to do that, but we may, if we can find a way to do it in the future, to find a scaling product or something like that that will do it for you, all the customization and everything, then we would definitely consider doing that. So with that said, I think I'm going to go ahead and end the presentation for today. Thank you very much. You guys had some wonderful questions today. Feel free to join me every week. Either myself or Lori will be spearheading this call. Occasionally you'll receive marketing emails that tell you what the subject matter is going to be. Today was kind of free flow, but if you guys need, if you have something that you'd like covered specifically, send us a note over at support. I'm always looking for ideas on what to put on this call. And in fact, if you have run across a strategy that you like and that you'd like to show everybody else, I'd be happy to bring you on so you can show it. So thank you again, guys. Have a wonderful day, and hope to see you all next week. Bye-bye.